commodities. We should also talk Treasuries. They jumped after the 10-year auction. Yields on the benchmark note near their lowest level in 4 months. Let's go back to Brian Luke. He's got more analysis from that auction. Brian?
Yeah, Julia, what we saw in today's 10-year auction was a little bit of a fair amount of a strong bid here. Now, what drove that bid also, it pushed yields down below rates where actually the bond was actually auctioned off. So those participating in the auction got a higher yield than where we're trading at right now. We're actually now below 3.2% on the 10-year bond. Now, that's a lot of interesting action right now, whether it's a high yield or low yield. We had George Congalvis at Cantor Fitzgerald on. This is exactly what he said about this particular auction.
The government bond market is still giving you some high real rate of returns, and investors are still questioning the outlook on the economic front. And you have that in a risk market and stock markets that perform so well. The last few weeks of the year, if you park and save cash and wait for next year to reassess your risk budget, the Treasury market will be a big recipient of that.
Yeah, well, he said that the stock market is going so well in the last several months. Well, so is the bond market. In fact, all U.S. bonds and stocks are being bought heavily since June. We show you exactly, not only today has the yield been driven down lower, but over the last several months, you see the rates used to topped out around 5% on the year, and now have driven steadily lower to about 3.2%. It's a big story here. Clearly, there's not a lot of inflationary fears that we're talking about. There's no bother worried about that compared to the last several months. Now, that's the question now. But then gold is a little bit a different story. There's a lot of up in price in gold, and some of that has to do with inflationary fears, right, Mike?
Yeah, Brian, that's right. I mean, there certainly is fear about inflation in the gold market, but there may be a little bit more to it. Yesterday, we saw this impressive gain in gold. It passed its nominal all-time highs of $1,033. A lot of technical buying, momentum buying. They saw strength. The traders did. They bought high. They're looking to sell it out higher. Today, we see a little bit of a consolidation, which is good from a technical perspective, up around $4 at $1,044. But the story behind the burners here, as Brian mentions, that there may not be a lot of inflation. It's about diversification of reserves by central banks. And we see that central banks, particularly in the oil-producing world, may be talking about moving out of the dollar as a peg for the currencies and also buying gold, perhaps, just to diversify the reserves out. Remember that if you hold gold reserves in the form of treasuries, every time the dollar weakens, your reserves, they get smaller and smaller. Julie?